What's up everyone? Welcome to the newest episode of the PerFinEx Community Investing, an episode in which we will be testing probably the most prominent stock market wisdom out there. You may have heard the saying before, sell in May and go away, indicating that you should sell all your investments before the summer break. But do you also remember the second part of the saying, but remember to come back in September? Well, September's over, just a couple of days, so let's see in this episode of our community investing if it's time to come back and invest again. And let's also see if you would have followed that old stock market wisdom, would your return be better than if you just buy and hold? Curious to find out? Me too, so let's go. So the question is, which strategy won, right? The trading strategy that follows the stock market saying and allows you to spend your summer at the beach, like the guys that you see here on the picture, or the investing strategy that just buys and holds all year round. By the way, I don't think I need to explain sell in May and go away, but remember to come back in September, do I? The old stock market saying suggests to sell all your stocks, ETFs and whatnot in May, Netflix and chill over the summer and then come back in September. The question is, why does this idea exist? If you know me just a little bit, you know that I'm not a big fan of myths and traditional thinking and the typical German.
We have done this for decades like this, so we will be continue doing it like this for another 100 years.
But in this case, you have to give it to the believers in the stock market saying. Historically speaking, the summer months are the months with the lowest return. Here you can see the German DAX in dark blue, the MDAX in light blue, the Dow Jones in dark red, and the Nasdaq index in light red, and their average returns each month over the last 20 years. You can see clearly that March, April, July, October, and November have been really good months, all positive on average over the last 20 years, and June and September are historically speaking the worst investing months when it comes to return. So the saying should actually be, but remember to come back in October, if you ask me. But anyway, the logic is clear when looking at the picture, right? Summer months have historically the lowest return, so just sell before that and buy again in October, because during the winter months the stock market offers the highest return. But don't jump to that conclusion too quickly. The chart looks a little bit more obvious than it truly is. First of all, it kind of depends which market you're looking at. When in May you're selling and when in September you're buying again, how many years you are backtesting this strategy, and much more. When looking at the data, it works about 50% of the time. When you invest a one-time sum, 20, 30, 40 years ago and check it until now, it's a little bit above 50%. And when you check it with a monthly savings plan, 20, 30 years ago, it's a little bit more below 50%. And if something works only 50% of the time, it's not a strategy, it's a coin flip. Especially in the last years like 2020, where the stock market went in March because of the pandemic, and then over summer 40-50% up. Check the charts, it looks like a V. Incredible. Oh, and remember that there are usually fees and taxes involved with any trading strategy. That makes it even more difficult for a trader to have a higher return than an investor. And even if you think now, oh wow, this selling in May strategy is really good. It works more than 50% of the time. Okay. But what about the US president cycle strategy, or the Halloween effect, or any other trading strategy? I'm not a big fan of market timing at all, and that's why we are not following any trading strategy with our community investing. You can do that with your own money, with your own investment account, if you want. Speaking about our community investing, all red again, which is no wonder because we've just seen that September has been the worst investing month in history. Thank you for that, September. Happy we don't see you again for another 11 months. High safety investing strategy that invests about 70% in global bonds and 30% in the global stock market is down by another 3.5% in September totaling a loss of a little over 9% since the start in August last year. Selling in May would have at least prevented the massacre that you can see in June here. It was all okay before that. Anyway, at least we got a nice dividend of more than 50 euros for every 10,000 euro invested. And since it looks like we're bottoming out at the end of September, hopefully there's a great winter with great returns ahead of us. I highly doubt it though, to be honest, with everything that is going on in this world right now. This seems certainly like one of the times in which you just continue to invest with a monthly plan, like many of you guys do, and myself included. And if you're not looking to make any great returns over the next 1 or 2 years, I am confident that we will all be fine. Financial markets recover always at some point. If you're looking to get at least some profits while waiting for the recovery, then maybe our passive income portfolio is right for you, because 2 ETFs paid a dividend in September, basically starting a streak again that we will hopefully continue. It was a little sad, to be honest, to see that July was the first and only month so far that didn't pay anything. August rewarded big time though. Other than that, the returns are surprisingly similar to the high safety investing strategy, even though the investments are completely different. Minus 3.5%, minus 3.8% in September, and minus 9.2% versus minus 9.4% since August last year. Crazy if you think about it. I mean, the passive income strategy has significantly higher risk as there are no bonds, and still the returns are equally bad. This goes to show that it might be a great time to start investing now before the markets recover eventually. By the way, before any of you comments,
Axel, your investing sucks. Minus 9%, you're a loser.
Here are the returns of our 3 investing strategies compared with the returns of the S&P 500 and the German DAX. All our 3 investing strategies beat both stock market indices on the year-to-date basis, and on the 1-year return, only the S&P 500 is a little better than our high return, high risk strategy. Speaking about high return, like the other 2 investing strategies had it before, a little over minus 3% return over the last month, and here minus 14 since the start in August last year. We try our best, but if the global stock market is down by minus 20%, what are we supposed to do here? Short sell? That is, by the way, what could turn around these negative returns really quickly, if all the short sellers that bet on falling prices are closing their positions. Let's see what happens. One thing's for sure, big dividends happened in September in our high return investing strategy, with an upcoming dividend mid-October from our healthcare ETF, with a little over 20 cents for each unit of ETF that you have in your portfolio. If you want to follow the alt stock market saying and come back in September or October, you can open your free Fidelity investment account with the link in the description. And after you identified yourself with post-ident or video ident, we will reach out to you to discuss the right investing strategy for your personal situation. Let's hope October is. See you in November, investors.